Hey, I'm Joey Tries Finance, and I'm here to tell you about more Series 65 study material. And today, we will be talking about pooled investments. On the pooled investments category that we'll be covering today, it will be open-end versus close-end, private funds, meaning hedge funds, private equity funds, and venture capital funds. And then on top of that, we'll be doing UITs, or unit investment trusts, exchange trade funds, or ETFs, and real estate investment trusts, formerly known as REITs. The primary benefit of a mutual fund is that it's a diversified managed portfolio, unlike that of closed-end funds, which just maintain a set amount of stock during the period of time, and it is not managed at all. It has reduced fees in that regard, and you don't have to deal with sales commissions like mutual funds, but it's not as diversified and constantly managed as you pay for with an open-end mutual fund. The benefit, though, is that it has significantly higher liquidity since its NPV is calculated daily, and they have a continuous offering of shares. With a continuous offering of shares, whenever you get dividends from investing in this, you can continue to add to your mutual fund and it appreciates over a long period of time. Now, on the other side, a closed-end mutual fund can be sold over the counter and can be sold at a discount, or it can be sold at a premium based on its share. It's entirely dependent on how much of the market actually wants to buy. Private funds are a little bit bigger. You invest a little bit more money than you do in mutual funds and closed-end funds. Hedge funds, for example, often have the baseline being $250,000 that you have to do to invest, or you have to be an accredited investor. There's various other things you have to do there, but it's really not liquid. You'll most likely be required to hold it for at least 12 months, most likely longer than that. But they have very flexible investment strategies because they're constantly investing with millions and millions and millions of dollars. And so they can actually change the market quite a bit more so than the average consumer such as ourselves that would invest. Then we also have private equity funds, which is structured as a limited partnership, and they do long-term investing, and they hold ownership for a long time because they're planning on investing in something that's really cheap and then exploding and changing the market. But the minimum investment is usually $25 million. So another thing, big ticket item, you got to pay a lot to get in there. And then we got also venture capital funds, which have higher returns with higher risk, like common stock, like you're meeting the risk with the gain, but it has a long investment horizon, like all other private funds, and it has a high growth company focus. Now we got exchange trade funds, or ETFs, is a pooled security fund. It's traded on a stock exchange. If you go around and look up videos, people will talk about index funds, index fund. This is an index fund. This is the market of it. But usually it takes over a certain set of stocks like the S&P 500 and then matches it pretty well. So that's usually a benefit. And then you can always do it leveraged in a direction, negatively or positively, and that's often what people do. And then we also have real estate investment trust, which is a pool investment that invests entirely in real estate related products. That being 75% of the total assets in real estate, cash, or U.S. Treasury, that's a requirement. And then additionally, they have to pay those that own this, almost like dividends, 90% of all the money they make, their taxable income, to the shareholders. And then it's also considered dividends. So this was my breakdown of pooled investments. Pretty basic. You can go seriously in depth to specific companies, but you'd have to usually look at specific companies to see what each of them got and stuff like that. But hey guys, remember, knowledge is power.